Hi all. Today I thought I'd speak about buy-to-let in 2025. There seems to be quite a bit of information out there saying it's becoming difficult or impossible, and many people are questioning as to whether it's even worth it. So is buy-to-let still worth it this year? We've had rate hikes, tougher rules, shifting markets, so I want to walk through what's still good, what's risky, and when it's a good idea to go for it, from my view as a landlord. Let's start with what's still solid, the things that make BTL something you can lean on even now. People still need somewhere to live. Home ownership is harder for many, so renting is still strong. I see in my area tenants are lining up, and that keeps your leverage. For example, a few months ago I had 3 properties that were vacant. All the tenants exited for different reasons, but within a month or maybe even less they were all fully tenanted again. And that's obviously because I work with a very good agency, which is something that I keep emphasising everyone should do. In Q1 of 2025, gross yields across the UK are averaging around 6.9% before costs, which is not bad. But after expenses, obviously this is lower, but it's a baseline that says there is room to work with. Interest rates are high, but there are signs that lenders are softening a bit on deals. It doesn't mean cheap mortgages, but maybe slightly more breathing space. If you lock in a good fixed deal, then that definitely helps. Most forecasts are predicting 2 to 4% growth by the end of 2025. You won't blow up overnight if you buy a property. It won't obviously explode, but you still might get capital gains over time, in addition to you collecting rent, because rules and taxes are heavier now. Many casual investors are dropping out. That means less competition if you're serious and structured, and you'll then be better placed to navigate yourself through this tougher environment. All that said, and yes, these are reasons BTL can still work, but there's no sugarcoating. The risks are stronger now. Let me flag what could bite you if you're not careful. Your mortgage might eat a huge chunk of your rent. If rates go up further, your profit could vanish. For example, my property last year, which I previously mentioned, after a 5-year fixed period, the mortgage payments increased by over 4 times. And that became a nightmare, but I navigated my way around that. There's a lot of regulation, compliance and tax headaches as well. Energy standards, tenant protection laws, tax changes, all those take time, money and effort. If you're not on top of them, they erode your margins. Many landlords now use limited companies to optimise tax. It's not optional in many cases, and I do the same. I have properties in my personal name, as I've previously described, but this was because I was misadvised, but for many years I've been buying in a limited company, which is the way people should generally be doing it. Location also matters more than ever. You can't just buy anywhere. In weak times you might struggle to rent or see price growth. You need to pick places with strong demand, jobs, infrastructure, otherwise you might get stuck. Defaults, arrears and repossessions are also issues. In Q1 of 2025, nearly 12,000 buy-to-let mortgages were in serious arrears. That's a real risk. If tenants stop paying or if you miscalculate, you could lose more than you're comfortable with. If you need cash fast, then property is a slow sell. You can be stuck waiting for a buyer, or you may have to accept a significant discount. To succeed now, you need more margin for error than ever. So for which kind of setups does BTL still make sense in 2025? It's important to leverage safely. Don't max everything out. Stress test your mortgage. A decent broker should be doing this for you, as is the case with me. So what if the rates go up by, say, for example, another 2%? Can you still survive? And this should all be factored in. You should have a healthy net yield. After all costs, maintenance, agency fees, taxes, voids, you still need a buffer. Don't just chase the gross yield. There should be a strong local market. You want places with growing jobs, people, transport, maybe university towns, commuter belts, cities with strong economies. Proper structuring is also important. Use companies or tax efficient structures where possible. Know your tax position. That's why it's always important to have a good accountant, financial advisor as well. Plan your time horizon as well. You don't have to do this in detail, but try to expect 5, 10 or 15 years ahead. You can still flip properties, but as long as they're sourced well, you could find a really good deal somewhere that really needs a strong refurb, and you could try to get the refurb at a decent price if possible, although this is becoming harder as well. But bear in mind that if you do refurb the property and then try to sell it in a year or two, we don't know what the market will be like then. You could have added a lot of value, but if properties in that area have a ceiling price or have not generally appreciated, then you might be in trouble. Also, always have cash reserves. My latest property purchase involves a property, and it was brought to me by someone I know, and she wanted to buy it, but she had used most of her savings on a huge landscaping project and therefore had no reserves and couldn't buy it herself. So her best bet was then to get me to buy it so that she could manage it so as to not completely lose out on the deal. It's very important to always have cash reserves. Different people have different rules of thumb, as I've mentioned in previous videos. Some people say 6 months costs, other people say a year. As long as you've factored in whatever you're comfortable with, then you should be fine. Always have spare cash for repairs of vacancies, surprise issues. The buffer can save you. If you do take into account most of what I just said, then BTL could still be a good move in 2025. It's not easy money, but a good business with good long-term growth and consistent rent. So is buy-to-let still worth it in 2025? It is if you do it right, but it's not carefree. The easy wins seem to mostly have been gone. If I was starting out, I'd probably be very picky, get good deals, low risk, a strong area with structure and buffer. For example, you can look at council plans to see if there's any developments happening in certain cities, and if there are, the properties in that area are likely to possibly go up in price or show that there's going to be a strong demand for rent in the future. If your numbers don't allow margin or you can't handle surprises, there might be better options. I would still consider investing, but more cautiously. For years, my properties have been treated like a real business. My accountant and property managers ensure that all costs are tracked, and I recycle most, if not all, my money back into the business. I'm not saying you have to do this, but this is just the way I am. As mentioned, I do keep reserves, and I don't look to put absolutely every penny into the next project. If this video helped in any way, please give it a thumbs up and subscribe. I'll share more of what's working in real time. Thanks for listening, and see you in the next video.